The first credit card I ever helped a customer apply for was rejected. She had a steady job, reliable income, her credit score was actually fine, but the bank said no, and what they said no tells you everything about how this game is actually played. Most people pick a credit card the way they pick a coffee. They look at what is offered, find the one that sounds best, and grab it. Banks do not pick you the same way you pick them. There are 4 steps a banker walks through before they say yes, and the first one is not even on most people's radar. Quick note, this video is for education only. It is not financial, legal, tax, or investment advice. If you need help with a specific situation, talk to a licensed professional. The customer story you are about to hear is built from real situations I worked through. Names and details are changed. The lessons are real. Here is what 20 years inside a bank taught me. The card you end up with matters less than the order you ask the questions. Most people compare cards in the wrong order. They look at rewards first, then maybe the annual fee, and they almost never get to the things that actually matter. I am going to flip that for you. Once you compare in the right order, the right card almost picks itself. And the thing nobody tells you up front is that step 1 happens before you ever open a website to compare anything. Step 1. Pull your full credit report, not just your score, the full report. Your score is one number, but underwriters look at 5 things behind that number. 2 people with the exact same 680 score can be completely different applicants, depending on what is going on inside the file. If you only check your score, you are looking at the headline. Banks read the whole story. And the good news, you can pull all 3 of your reports for free, as often as once a week, through the official bureau access. No payment required. Here are the 5 things a banker looks at separately from your score. 1. The thickness of your file, how many accounts you actually have. 2. The age of your accounts, how long they have been open. 3. The mix, cards, loans, lines of credit. 4. Recent inquiries, how often you have applied lately. 5. Derogatory marks, late payments, collections, charge-offs. And one quick note, if you are under 21, federal credit card law requires you to show proof of independent income before you will be approved. Now you have read your file like a banker would. The next question is bigger than which card looks best. Step 2, match the card to your situation. Not what you want, what you actually have. Here is where my customer made the mistake that cost her 2 months of credit building. She walked into the branch with a card in mind. Beautiful sign-up bonus, cash back on groceries, a metal card that arrived in a black envelope. She wanted that card. Her file said she was not ready for it. She applied anyway. She got denied, and here is what most people do not understand. The denial was not the worst part. The hard inquiry from that application stayed on her file. Her thin credit history just got thinner. When she came back to the branch 2 months later, she was in a worse position than the day she first walked in. Same job, same income, lower score, and 6 months on the clock before any major issuer would even consider her for a new card. So what should she have done? That depends on what kind of file you actually have. There are 4 situations a beginner can be in. If you have no credit history at all, you need a card built to report cleanly to all 3 credit bureaus and graduate well. Rewards are a distraction at this stage. If your file is thin but clean and you have steady income, you can probably qualify for an unsecured starter card. This is where the rewards conversation can begin. If your file has damage on it, you need a secured card or one built to approve damaged credit. Anything else is a hard inquiry you cannot afford. And there are alternative paths. Becoming an authorized user on a family member's card. Cards that approve you on bank account history instead of credit history. Those are their own video. Once you know your situation, you have the type. Step 3. Compare cards in the right order. Most people start with rewards. 3 browser tabs, cash back rates. Pick the highest. That is the wrong order. The right order starts with something most people do not even know exists. And once you know to look for it, you will never pick a card the same way again. Compare bureau reporting first. Here is something almost nobody tells you. Reporting your card activity to the credit bureaus is voluntary. The card company does not have to do it. Some cards only report to 1 bureau, some only report to 2. If a future lender pulls the bureau your card did not report to, it is like the card never existed. Every major card company in America reports to all 3 bureaus: Capital One, Discover, Citi, Chase, Wells Fargo, Bank of America, American Express. Smaller issuers may not. Check the website before you apply. They will tell you which bureaus they report to. After bureau reporting, here is the order that actually matters. Reporting timing. Some cards report at statement close, some monthly, some take 60 days to first appear. If you are trying to build a score in 6 to 12 months, timing matters. Then read the disclosure box on the application. Most people do not know it has a name. It is called the Schumer box. Federal law requires it on every card application. Every fee, every rate, every penalty in a standardized format so you can compare apples to apples. Then your realistic interest rate. The range you see is wide on purpose. Beginners with thin or damaged files typically land near the top, and only now do you look at intro offers and rewards. They are the smallest factor for a beginner. Step 4. The tiebreaker. When you have two cards that pass the first 3 steps and you cannot decide between them, here is the question banks would ask if they were on your side of the table. Where does this card lead next? Your first card is not a destination. It is a launch pad to your second card 12 to 18 months from now. And the question that separates a good first card from a great one is hiding in plain sight. Some card companies automatically consider you for a credit limit increase at the 6-month mark. Capital One says platinum cardholders are automatically considered in as little as 6 months. Important word there. Considered, not approved. Whether you actually get the increase depends on your income, your utilization, and your overall profile. The Capital One Platinum Secured Card works the same way. After 6 months of on-time payments, they will review your account for a higher line with no additional deposit needed. Other major issuers like Bank of America, Barclays, US Bank, they generally make you reapply, which usually means a new hard inquiry. That difference matters a lot. 3 more tiebreakers. First, will this card stay open after you graduate? Cards with no annual fee can stay open indefinitely, which keeps your credit history length growing. That length is roughly 15% of your score. For a first card, no annual fee is the better long-term play almost every time. Second, existing relationships matter. If you already have a checking or savings account at a bank or credit union, applying with them can mean an easier approval and a better starting limit. Third, soft pull versus hard pull. Capital One uses a soft pull when you ask for a credit limit increase later. American Express and Chase do too. Bank of America, Barclays, US Bank, they generally use a hard pull. So what happened to my customer? She came back the second time, same job, same income, slightly lower score from the inquiry. This time she did the steps in order. She pulled her full report and read it. She matched the card type to her situation. She narrowed by what actually mattered, and she picked the boring secured card with a graduation path. 12 months in, her credit limit was raised automatically. 18 months in, she graduated to a much better card. And here is the part she told me she wished she had heard from me on day 1. She did not get the rewards card by applying for it. She got the rewards card by qualifying for it. If you are starting from no credit at all, the video that pairs with this one is the 12-month plan a banker would use to build credit from zero. The card in the corner will take you there. And here is the bigger lesson behind every step we just walked through. The framework is not really about the card. The framework is about how you think about cards. Once you can read your file like a banker, once you know which type to apply for, once you know what to compare and in what order, once you know the question that picks the tiebreaker, you are not picking your first card. You are picking every card after that. Subscribe if you want more videos like this one, where someone with 20 years inside the bank tells you what the marketing pages leave out. Pick the on-screen video next. It is the natural next step from here. And remember this, banks have a process. Now you have one too. I will see you in the next video.